The financial spider ETF near correction levels, down about 9% since its January highs. And this as we look ahead to Thursday's banking stress test results.
Joining us now to discuss, Chris Whalen from Whalen Global Advisers and Dick Bove from Hilton Capital Management. Gentlemen, good afternoon to you both. Dick, I'll start with you in terms of whether these are going to be a massive market-moving event, these stress tests, or do we expect all of the banks to pass?
It's very hard to believe it'd be a massive market-moving event because, you know, the banks in the United States are in extraordinarily good condition from a balance sheet standpoint. And I think the market understands and realizes that it would only be a market-moving event if some bank failed to pass whatever the tougher, there are tougher standards this year, if they fail to pass whatever the tougher standards are. But I don't really envision that happening.
How about you, Chris Whalen? So you agree? You're sanguine about the results?
I don't pay attention to the stress test, Michelle. The Fed made a terrible mistake by making them public, and it's become a media circus. It has no value analytically, so I don't spend time on it. I do worry a little bit about Deutsche Bank, who may get dinged now that the Fed's enforcement action is public. I believe the Journal wrote that story. And then Wells, you know, they've had their problems. I think they're going to fix it. But again, the Fed is out there with some pretty stiff sanctions on the bank. So we'll see how they finesse that. I don't know how the Fed can't take action on Deutsche, given the fact that we know what they've been doing in the background. And again, this is why the stress test should not be public. It's a terrible, terrible mistake.
Dick, Goldman Sachs suspended their buyback at the last set of earnings. A lot of people said that's because of the CCAR test. So once they get past it, could that not be reinstated? And which of the other big cap banks do you think could move the needle on buybacks or dividends based on these results? Well,
again, I think I would hope that Goldman Sachs never reinstates its buyback program, because I think that buyback programs really have significant negative impacts on banks. They may assist the stocks for a short period, but they certainly didn't help the stocks in 2018. And I would guess that, you know, people will talk a lot about whether this company or that company is going to increase its, you know, buybacks, or whether it's going to adjust its dividends one way or the other. But that's not what drives the stocks. In other words, the eyeball has got to be put on what is important, and Chris just made the most important statement of all. It's not the CCAR. It's what these companies do in selling products through their business, and because they haven't been selling products through their business in 2018 at a very attractive rate, the stocks have not done well.
Yeah, what is the problem with the stocks? Mike Santelli, what is the problem here? When you look at all of the banks that are labeled as systemically important by the Financial Stability Board, 50% of them are down in a bear market year to date at a time when the economy is doing okay, supposedly interest rates are going up. I mean, if banks can't move higher in this environment, when are they going to move?
I do think the cover story is the yield curve flattening, even though that's not really a direct impact too much on exactly how much these banks earn. The European banks, I do think it's a sentiment issue, if nothing else, right? I mean, the fact that they are not as well capitalized, it makes you wonder about just exactly how flush the whole system is. But beyond that, I think that's also this market has been infected by how late are we in the cycle thinking, whether it's correct or not. The banks kind of suffer a little bit from that debate.
Chris Whalen, we hear you. I think I hear you going,
Well, no, look, the banks had to work very hard in the first quarter to hit their numbers. They put a lot of sail up, if you take a maritime metaphor. So, you know, but they're not growing. They're going to be paying capital out to investors, as Dick said. And the fundamental problem is they did really well last year, extraordinarily well. And it would be unreasonable to expect them to still go up, Michelle, given the valuations. They're fully valued. And these are utilities now. There's no alpha. So the street increased their allocation, you know, and we are where we are, you know.
Yeah, you know, I'm jumping up and down because basically, you know, you have such a narrow focus on this industry that you're missing the ball game, okay? Basically, the banking industry is not 6 companies. The banking industry is composed of 400 companies. And if you would take a look beyond the 6, you would find that banks in the mid-cap area have been soaring this year. They've been doing extraordinarily well. You know, there are many banks that have outperformed Apple this year. And the fact of the matter is that since no one cares about, other than investors who recognize what's going on, since no one cares about talking about anything except the 6 big banks, you're missing the whole ball game.
Oh,
you
totally,
could have made
Dick. Dick, that's very kind of you to air an exchange that you and I have had plenty of times on email, on television.
No,
we do acknowledge them, we do talk about them, but it's also based on average trading volume, which is what relevant to our viewers as well. So that is why we talk more about the big caps.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.